everything the American dream is built on that's being squandered and wasted in an inefficient and broken system. And there's a better way to do this.
Welcome back to another episode of the Frustrated CEO Podcast. My name is Patrick Lyons. I am one of your co-hosts. I'm still flying solo because my co-hosts, Patsy Feeman and Lev Tannenbaum, are still out traveling the world. And I'm stuck in here. Actually, I'm not stuck. That sounds horrible for you, Chris. I actually have the pleasure of sitting for episode 2 with Chris Hamilton. Now, if you, listener, are just stumbling across this episode and did not go back and listen to episode 1, then you may want to either pause this and go back and do that, or just make sure that, actually, I think that's what I would recommend. But if you refuse, make sure you go back and listen to episode 1 after you listen to this episode, because it provides a lot of context for how we got here. Now, this episode with Chris, we're going to be digging into what do you as a business owner do about it? How can you build that future-proof business with high performance, cost saving health plan? Chris described it well in episode 1. I'm not going to repeat that. Go back and listen, but that's what we really wanted to talk about today. So let me introduce Chris, tell you who he is and why we're here, and then we will be off and running. So Chris Hamilton, as we said in the last episode, is partner at Hotchkiss Insurance in Texas, where he leads the employee benefits consulting practice. He specializes in managing healthcare and insurance costs to improve benefits coverage, reduce expenses, and enhance employee health outcomes. If you recall, he spoke about how he spent quite a bit of time in corporate finance. So he's attacked this problem from a financial or through a financial lens, from a financial perspective, with the idea of, do we really just have to accept these costs as they are, or is there something that we can do about it? Now, one of the questions that I have for Chris, this kind of came up as we were in between episodes, just talking about, just reflecting. Chris, there's a why behind everything that we do. There's a why behind what we do. And you shared, you've got a goal on a whiteboard in your office. What is that goal? And, and why? To me, I think that's the driver behind all of this work that you're doing.
Yeah. So I've got the number 1 million written on at the top of my whiteboard, and the million represents the number of lives that I want to impact in our country over the next decade. And, to accomplish that, I don't have the capacity or the capability to work with employers to generate 1 million lives being covered. So I frequently travel the country. I speak at conferences. I train other advisors to do what we do here at Hotchkiss Insurance to help employers offer better insurance and lower their costs for the company and their employees. I work with numerous vendors in the health insurance benefits space, whether that's group health captives or pharmacy benefit managers in advisory capacities to help them design their products and make them more effective and efficient, wring out wasted expenses. Really the bigger why of why I got into this industry, having a corporate finance background, I saw companies struggle with rising health insurance costs and didn't really have an answer on how they were going to solve it. And it got me thinking about the magnitude of the issue. Health insurance is expensive. It's one of the largest components of our GDP. It's over $4.5, almost $5 trillion that we spend every single year, and it's rising. It's not only a societal problem that we face in our country, it's an economic problem. And what I mean by that, if you think about what companies are spending on health insurance and it rises every year, that's money that's no longer being reinvested into their business. It's no longer going into pay raises for employees, investing in new technology, reinvesting in an expansion and growth in the business. It's money that's being given away into a broken system. But when you further expand on that for the employee, and I did not realize this when I got into the business. I got into this business to help companies improve their cash flow, improve their EBITDA margins by reducing the expense in health insurance. What I realized as that secondary effect is, oh my gosh, the impact I'm having on an employee when they're able to go have a surgery and get an expensive medication for free. I mean, I've gotten letters and calls from employees of my clients telling me this changed my life. I didn't have the money to get this procedure, and I was able to get it through my employer health plan for free at no cost, and the employer saved in the process. But when I think about what happens with our employees, and this is society at large, you think about the money that people spend on health insurance, and that's just to get access to coverage. And then when they actually need health care, they spend thousands of dollars out of pocket to get the health care that they need. And if you think about your average employee, maybe they make 50 or 60 or $70,000. If they're paying $18,000 to $20,000 to cover their family, and then another $5,000 on top of that, that's a third of their income. And
Right.
that's money that is not going into college educations for their kids, retirement, saving for a new house or a car, a vacation. It's everything the American dream is built on that's being squandered and wasted in an inefficient and broken system. And there's a better way to do this. And that became my mission very quickly in this business once I understood the downstream impact that was going to have on people, their families. And that's really the passion that fuels me to solve this and teach other people how to do this. I had a really interesting opportunity over the last couple of years in Texas. We've got a quasi-governmental entity that is the largest workers' compensation carrier in Texas. They don't do health insurance until now. And I had the opportunity to work with them and consult on the business plan on how to design a program to be able to do all the things that we're going to talk about today, where we can make health insurance more affordable for businesses and employees. People have access to doctors that they wouldn't otherwise have access to, medications, surgeries, all sorts of things at a reduced cost. And they've been able to take that downstream into into a smaller employer market that with a product that didn't exist before. And so there's going to be a lot of things that we talk about in this particular episode. Some of it's going to be state specific, but there are people out there challenging the status quo of what's possible in every state. So it's just important to align yourself with an advisor that's trying to solve that problem. They can bring those perspectives and solutions to you.
Yeah. um, that's awesome. Thank you. I just asked you about the why and what's the why behind this. Now I want to help me answer the why for our listener. Right? Okay. Let's acknowledge it's may not be prudent. It may not be cheaper for me just to auto renew every year. Right? It's out of
Mhm.
control. Um, so there has to be something. It may not be prudent, but it's easier, right? It's easier
Yeah.
just to do that. It's more work. One of my favorite sayings comes from a consultant, a speaker named Ford Taylor. Ford's, I stole this like 15 years ago and I've used it a lot, but I always give him credit. He says, change happens when the pain of change is less than the pain of staying the same. And we're all wired that. For some of us, the pain of change is pretty nominal, and therefore we love change. But for some, the pain of change can be pretty significant, and therefore we just put up with the status quo. So, what's in it for? How do we create the how do we lessen the pain of change for the business owner who's thinking, okay, if I'm intrigued, it'll keep my costs down, but is it purely about costs? Talk about retention from your as you've worked with clients. What's the impact that you've seen on the why? Why should a business owner want to do this? And then we can get down into great. What specifically should they be doing?
Yeah. So I'm going to back up and answer the question we talked about it in the first episode. How do we lessen the pain of making a change? How do we make it easier for employers to make these sorts of changes? And it goes back to starting early.
Okay.
So typically what happens with most companies when they do their health insurance renewal, they wait until about 60 to 90 days before they get their renewal, about that timeline. And then the broker goes to work shopping insurance companies, and then they're usually bringing back those options with a very short window to make decisions. And you're being tactical at that point. You're not being strategic.
Yeah.
And so the biggest piece of advice that I gave was get involved in the process very early. It's not more work for a company. It's more work for an advisor. An advisor should be willing to do that sort of work. That's what you hire them for. It's not just the placement of insurance. It's putting together a long-term strategy to help you meet your goals. And so that process should start shortly after your renewal. And I would probably say the latest that process should start is about 6 months before your renewal. That would be the latest if you want to take a really good strategic approach. because that gives the advisor enough time to do all the legwork that they need to do to be able to present a strategy. And then with that strategy, we get tactical with, okay, these are the goals for year one. This is how we're going to address those. And then when we get to year two, we attack year two goals and those sorts of things. So getting involved early is going to lessen the pain of change. That's the first thing. But let's talk about impact. That was the second question that you asked. I'll just give you an example of one of my clients that's here in Fort Worth, not a large employer, but not a small one either. They're about 80-ish employees.
Mm-hmm.
So that's not a Fortune 500 company, but I would tell you today they have Fortune 500 actually their benefits are probably better than many Fortune 500 companies.
Mm-hmm.
And I'll just kind of give you the impact that they have seen and what their employees have seen. So about almost 6 years ago, they hired me to solve this particular problem of rising health insurance costs in their business. They were paying about $1 million in premium for their employees, and their broker brought the renewal, and it was a 30% increase in their premium. So they were going to go from paying $1 million to $1.3 million. And the broker said, there's not anything that we can do about it. The other insurance companies declined to quote this. And so, that's a common theme that we hear. There's not really anything you can do, just renew. So why do companies do that? Well, you feel like you don't have a lot of time and you don't have a lot of options. And this broker, the advisor, they're the expert in the market. They're telling me the other insurance companies can't do anything. So I guess I'll just renew. It's kind of painful. My employees are going to pay more next year, and my company's going to pay more next year. And maybe we need to adjust our prices with our customers to offset it potentially.
Right.
But this owner and the CEO and the CFO, they challenged that status quo, and they said, well, what else is out there? So we talked about access to data, transparency. And I said, in this model that you're in, there's very limited information. I can see what they paid for these biggest claimants, but I don't know necessarily exactly what they're buying other than this one medication that I can see is really expensive. To get access to this data, you're going to have to move to a different type of program that's going to allow us to manage the expenses the same way that you do everything else in your business. And so this group opted to move into what's called a group health captive. We can get into the weeds on what that is. But essentially what they did is they became a partially self-funded plan. There's ways to design these plans that make them safer financially than a traditional fully insured plan. It comes with all these benefits that they get to see how the sausage is made. The advisor is going to be able to show you, this is what you're paying for insurance. This is what you're paying for healthcare. We're going to bring these vendors into your health ecosystem to provide these benefits to your employees. And so the very low hanging fruit in that plan was their pharmacy benefit spend. So I talked about how in our previous episode, how traditional insurance companies monetize egregiously oftentimes the cost of medications. Well, if you put the right programs in place, contractually, you don't let those PBMs make money and spread, rebates come back to the employer. There's a way to design this to make it very efficient. We more than cut their pharmacy spend in half. We have programs that we find the highest performing surgeons in the market, and we are able to negotiate better pricing than what insurance companies can obtain. So you think about a hip replacement. That hip replacement in my market is going to run anywhere between $60,000 and $90,000 for that procedure with a traditional insurance company. Those same surgeons will do that procedure for $20,000. So if you're able to reduce the cost of healthcare in that plan, we're not limiting access. We're going to give this to the employees. They need it. Let's pay for it, but let's make sure we're paying a fair price. It goes back to that example I shared in the last episode. Would you pay $100,000 for a 1998 Toyota Corolla? No, that's like a $2,000 or $3,000 car, but insurance companies will pay that because the hospitals demand it. There's different ways to design these plans where you're able to pay a fair price. When you do that, you're able to essentially, you give the employee an option. You have a network on your card. Maybe it's Aetna or United Healthcare or Cigna, whatever the insurance company, that's there. But there's these other benefits that are layered on top of it. When you are the insurance company, you can control what's offered to your employees and you can offer additional benefits. So if you're willing to go through these other programs that we add on top of your benefits, we coordinate your care. If you want us to do that for you with the best surgeon in the area, you can have that surgery for free because we're not paying $60,000 for the hip replacement. We're paying $20,000. You get access to these great surgeons, but we're paying a fraction of the cost. We can pass that savings on to the employee in the form of waived copays, deductibles, and out-of-pockets. The employer's winning in the process. You just save $40,000 on a claim. If I ask a CFO, will you waive somebody's $4,000 deductible to save $40,000? They're like, a 10x return? Yeah, all day long.
That's right.
So it's aligning the incentives of the insurance company, the providers, and the members. make it a choice. It's not mandatory. You don't have to do that. But if you do it, there's a huge benefit to you. So let's talk about impact of this. What happened with that employer? So the very first year, they were going to spend $1.3 million with Blue Cross Blue Shield. Okay. When they moved into this particular program, they spent their actual cost at the end of that year was $700,000. So it was a $600,000 savings that they banked because they paid in the 1.3 they thought they were going to spend, but they retained $600,000. So when they finished the first year on their balance sheet, they've got a $600,000 surplus sitting in their checking account that they dedicated to their health insurance. And guess what? Fast forward 5 more years, they had that same experience. So you saw a big cost reduction in year 1, and that trended flat for the next 5 years. So what did that mean to that company? Assuming that there was no increase, assuming they had stayed in a traditional plan, there would have been some sort of increase, 5, 10, maybe a year where it's 20 or 30%. But if you say, let's just keep that high water mark where it is, we don't increase the premium, let's just benchmark it to a flat traditional plan. They saved over $2.5 million over that 5-year period of cost avoidance. They would have paid that to a traditional insurance company. It would have been money they had given away. They retained it in their business. What did that allow them to do? It allowed them to invest, revamp their technology platforms. They were able to invest back into their business. They were able to lower the cost of health insurance for their employees in subsequent years, particularly covering dependents. If you've got spouse and children, family coverage is super expensive for a mid-sized company. For that employer, it was like $2,000 to cover your family. And they're paying a fraction of that now. It's a few $100s now to cover your family on that plan. So they're giving a real benefit to their employees, and they're saving money at the same time. And I talked about the impact that's needed in our society, right? So it's an economic problem. It's a societal problem. You can solve that. It's going to be really hard. You asked me about legislatively. Can we change this and stroke a pen and solve this problem nationally? We don't have to wait for the government to take action. The solutions are actually there and available to employers today. And employers have been doing this for dozens of years, at least 20 years. Go back. There's a book I read. It was The Company That Solved Healthcare. If somebody wants to see this in action, it's a mid-sized employer, a distributor, wholesaler that supplies the auto industry. And the gentleman wrote this book. He was the CEO that wrote the book about how he solved step by step rising health insurance costs in his business. He's a low margin business. Rising health insurance costs threatened to put him out of business. And he knew, I have got to solve this problem or I'm going to be out of business in the next 5 or 10 years. I can't continue to get increases the way I'm doing this. And he walks through systematically. And I read the book and I thought, oh my gosh, when was this book written? And I go back and it was written in 2009. That's before the Affordable Care Act. Before the Affordable Care Act. And many of the things that he's talking about in that book, the same principles apply in practice today. Now, some of the strategies have changed because the market has evolved since then. But in principle, what he's doing is, how do we create transparency? How do we align incentives of everybody that's involved in this buying chain? How do we incentivize people to make good decisions? And when they do, they win. If you do that through the entire value chain, you incentivize your employees and reward them. You incentivize the companies that you work with, whether it's a health insurance carrier or a PBM or the care vendors that you work with inside that plan. You incentivize them to work in your best interest. And you as an employer, you design the plan to make it efficient. That's designing a plan for success. Traditional insurance plans are not designed to do that. If you think about any of the big 4 insurance companies, they're middlemen in a transaction. Their profit margins are capped. They're simply, the way I describe them, they're a Vegas bookie. I've got winning bets and losing bets. I just need to make sure I arbitrage properly and I skim my 15% profit margin, and I can monetize the claims as they come through. That model is rife with conflicts of interest and misaligned incentives that allow them to profit off of each of us. And it's exacerbating this societal and economic problem that we face. And it's not, it doesn't appear that it's getting any better. It's only getting worse. And so the real winners of this are going to be folks that challenge that status quo. The earlier you do it, the better. And so my advice is, back going to the first episode, you need to be asking the question, why and why not of this. So I know that's kind of a long-winded rant.
Great.
That's my perspective on it.
That was all really good. One of the things you said in there, in that answer, when you're talking about the hip replacement, for example, right? Through the insurance company, through traditional insurance, that would be $60,000. Then you said, if I heard you correctly, you said, but that same doctor, that same surgeon, would do that surgery for $20,000. In the last episode, we talked about how culture lives in the stories that people tell.
Yeah.
I I I can hear a listener or employees when you start saying, well, we're going to do something a little different. We're not going to do traditional. People go to, well, I'm not going to get the same surgeon. I'm going to get I'm going to get somebody not as good, not as reputable, not as experienced. Did I hear you correctly that it's the same surgeon or it's the same surgery that I can get? In other words, is there a real drop off in coverage because the major carriers have all the best people on payroll, and if you're not on those payrolls, you're probably a quack doctor.
One of the number one things that I want a listener to take away from this is, and when I say healthcare and health insurance is broken, people probably would agree with that. In America, it is.
Yes.
It is not an efficient market. This is the number one thing you have got to understand. There's a disconnect between price and quality in healthcare. And when you look at the data, and the data that I'm talking about there are numerous data analytics platforms in our industry that show this. When you look at quality, what are the rates of infection? What are the failed surgery rate, the readmittance rate, the mortality rate? How many people died from this physician doing this particular procedure? That data is available.
Mm.
And when you take that data and you overlay it with price, there's a very startling and not what you would expect outcome. The highest performing surgeons are often not the most expensive. In fact, it's the opposite. The highest cost providers are typically the lower quality ones. And that just flies in the face of all logic, right? We think we pay a Ferrari price and we get Ferrari quality. In fact, you should be paying Toyota price and getting Ferrari quality. Why is that? Well, the highest performing surgeons are typically the ones that are doing that surgery all day, every day. They book an OR and it's blocked for an entire day, maybe 2 days back to back. They could do that surgery in their sleep. The guy doing the hip replacement, he can be whistling Dixie and doing the surgery. He could do it like a robot because he's doing it all day, every day. But the guy that only is doing maybe 1 or 2 of those surgeries a week, probably not as skilled. And so oftentimes the providers that are doing that volume and that skill level, they have a different price point. And so when we look at that data, that tells us who we should be targeting. So the other thing I would mention is when you think about big insurance networks, they trade on, name a big insurance company, everybody's in network. Well, when everybody's in network, that means you've got the really good doctors in network, but you probably also have the really bad ones in network as well. So I'm a big fan of choice. I want to give people options. People want choice. If you give somebody a choice and they make a decision, they're probably going to be more satisfied because they had an option versus dictating to people you have to go here or else it's not covered. I don't like that model. So that's why we do work with networks. We're using the national networks. That's the option if employees want to, but you have another option if you want somebody to help you select a surgeon who's also happens to be in that same network. We've just vetted it out for the highest quality providers. Usually another question I get is, well, why would that doctor take a lower price? Why wouldn't they just do the insurance and get a higher reimbursement? And so it's taking advantage. You could call this arbitrage. But if you go to a provider, one of the things that providers, you ask a doctor about this, they'll complain about. They don't like dealing with insurance companies because they submit a claim, the claim gets denied, they didn't provide the right paperwork. The administrative burden of a physician's office is super high. It's like 8 or 9 people in admin and billing for every one physician. And that's to do all the coding and the billing and all that. And then they got to wait 60, 90, 120 days to get paid. Right. But if I go to these surgeons, and we have different groups that we work with to help us get these contracts, but if I go to that same surgeon and say, hey, let's just cut out the insurance rigmarole. What if I was willing to steer patients to you? You're going to have an incentive here because the employees, when they come to you, they're not going to have to pay you anything. We're going to pay the full cost of it. So you no longer have to collect a payment from somebody or chase collections. And that's a big deal for doctors' offices. They have to send people to collections and court and wherever else to get their money, file on people's credit, that sort of thing. So they're not getting paid by the member immediately. So there's administrative burden to that. But then we say, if the patient's not paying anything, we give you priority. You're going to have patients that come to you. So it's going to be more volume to you. And by the way, when you do this procedure, we're going to pay you sometime between the day of surgery or within 7 days. You submit the claim, we're going to wire the money to your bank account and you're going to have the money. and there's no more of this administrative burden and filing a claim and refiling a claim and dealing with an insurance company, you know what? A lot of providers, a lot of doctors like that model.
I bet.
Because if you think about it, these doctors who are high performing, they're blocking OR time. If marginal revenue exceeds marginal cost, that's a win. I'm already here in the operating room. I've already got the day blocked. Of course, I'll slide one more patient in, and I'm going to make on that hip replacement. That's a free $20,000 to me.
Yeah.
And so it's again aligning the incentives, creating efficiency. Everybody can win in that scenario.
Yeah. Okay, so how do you do it? What are some of the strategies that you've used? And
Yeah.
you've already touched on a couple, but if I'm a listener, I'm intrigued. How do we do it?
So the number one strategy that we're using with employers is breaking them out of that traditional, what we call fully insured insurance model. So fully insured plans are really simple. An insurance company is going to give you rates, and they're going to guarantee those rates for 12 months. So you buy the insurance, and to cover an employee, it's $600 a month, and that rate is guaranteed. The insurance company is going to do all the administration. They're going to pay the claims. They're going to do their whole thing. And then at the end of the year, they're going to give you a renewal. So the first thing I tell employers is, believe it or not, you're already self-insured, whether you're fully insured or not. I called fully insured plans delayed self-funding. What happens when your claims are high in that plan? They're going to increase your premiums at renewal. That's what happens. And so your experience is going to dictate the renewal that you're going to receive. So
Mm.
your claims are really what's going to drive your premium. So wouldn't it make sense to get some visibility and have the ability to have some sort of control and purview over what's going through your plan and how are you paying for it? So to do that, you've got to break away from a traditional fully insured plan, and you've got to move into what's called a partially self-funded plan. So when I'm going to use the term self-funded, unless you're Amazon or Walmart or Home Depot, some big national Fortune 500 company with several 100,000 or millions of employees, you're not going to be fully self-insured. You're always going to have a carrier that you work with that's going to insure your large catastrophic claims.
Okay.
But all partially self-funded plans are not designed equal. I'm a big fan of group health captives. And all a group health captive is think of it as probably not real good terminology, but think of a co-op or a consortium of employers, like-minded employers that say, we're sick and tired of not having visibility in our plan. We want to be self-funded, but it feels too risky to us. Let's band together to buy insurance at scale. And so you'll have groups that a captive that has 500 employers in it. And those 500 employers might represent 50,000 lives. Well, now, or 50,000 or more lives. I mean, there's one that we work with. It's got about 300,000 lives in it in particular. So now you're buying insurance as a Fortune 100 company at that size. So what does that allow us to do? It's law of large numbers. It's risk dispersion. It allows us to get contractual provisions in our contracts, protection that we need to make this really safe as a self-funded employer. So we know what to expect, and we can predict what our costs are going to be 3 or 5 years from now. We know what the worst case scenario is. And once you know that, you can work backwards from there. So I'm a big proponent of partially self-funding employers. We do that for employers all the way down to 25. If you have 25 employees or more, the real sweet spot's around 50 or more. And that allows us to have full customization of what network you use, who's your pharmacy benefit manager, what other customized care programs that we want to provide the employees that help them get a better experience, better healthcare, and lower costs. You can't do that inside of a traditional insurance plan. The carrier handles all that, and they don't have any incentive to have you helping them lower costs because at the end of the day, they're monetizing a lot of the claims. As we discussed in the prior episode, they make money through a lot of those inflated claim costs.
Right.
So that's the primary strategy that we're using for employers of that size. When you move downstream, so you're talking about kind of that 2 to 50 or 2 to 25 market, what can an employer in that size segment do? Well, there's a couple things. I mentioned there are other carriers, and some of them are state specific, but we're seeing carriers enter the market, competitors to the traditional insurance companies that have the same philosophical alignment. They understand that the price of insurance is going to be dictated by the price that we pay for healthcare. And they're designing networks with those higher quality, lower cost providers. And they provide incentives to employees to do certain things. So maybe it's getting a wellness exam. and willing to consult with somebody before they have a surgery. We're going to help you pick somebody. You don't have to use them, but if you do, here's the benefit to you. So there are carriers out there that are using some of the philosophies and strategies that we're using with larger employers, and they're packaging it inside of a more traditional type plan. So it would be more like a fully insured plan where they manage the risk, but they're designing it kind of with that same mindset of how can we help employees get what they need at a lower cost. When we do that, it lowers the cost of insurance and makes it more sustainable over the long run. Maybe you have an employer that's kind of in that smaller segment and says, that all sounds great, but I really need a name brand. I really I need to stay with a traditional insurance company. What can I
Right.
do here? And so one strategy that I would use in that situation is what's called a health reimbursement arrangement. So think about the insurance plans that are offered by that employer today. Maybe they offer a $3,000 deductible and a $2,000 or $1,000 deductible. The idea here is that when we look at the data actuarially, just a huge data set of employers, inside that group, you're going to have the majority of the healthcare spending is done by a very small percentage of that population. So you're looking at 2 to 10% of the population that drives 90% of the utilization. So what that tells me, and when we just look at that extrapolated out, typically the majority of participants are not going to hit their deductible. They're going to go in, they're going to have a preventative visit. Maybe they've got a sick visit or two. They're taking a basic, generic medication for blood pressure, cholesterol, or birth control, whatever it is, right? It's not really expensive use. But then you also have somebody there that's undergoing cancer treatment, or they've got a chronic condition that they've got to take an expensive medication for. Okay, those people are going to hit their deductibles. So the game here is arbitraging the insurance company. And so instead of buying $1,000 deductible, let's go buy a $6,000 deductible or an $8,000 deductible. What does that do? Well, that's going to lower the insurance premium in a fully insured plan because everybody's taking on more risk. But I really want my employees to have a low deductible. And so in that scenario, what that company would do is they would bring it. They would hire an administrator. It's nominal. It's a few dollars a month per person to do this. But that administrator, if an employee goes in and exceeds that deductible threshold that you set, so you bought an $8,000 policy, and maybe the employer wants to cover, they want the employees to have a net deductible of $2,000. If my wife is going to go have a baby, I'm going to hit my $8,000 deductible when that happens. And so in that scenario, what the employer is doing is they're funding this account that's designed to reimburse employees that $6,000 of deductible that exceeded the $2,000 deductible the employer wanted them to have.
Right.
Probably a little confusing seeing it. I'm more of a visual person, but essentially you're buying less insurance and you're only paying for what the employees actually use. And so typically when you do an arrangement like that, depending on where the start point is, you can lower the premium, 15 to 20%.
Mm-hmm.
By the time you bake in the reimbursements, you're looking at anywhere between a 10 and 15% net reduction in costs, versus just staying with your traditional low deductibles or mid-range deductibles. I also call that, it really, at the end of the day, what it is a mini self-funded plan because they're self-funding that deductible layer, if you will, for employees. But it is a strategy that we've seen and we've used it for many years, and it works for employers that are just not ready to kind of take that leap into a different, partially self-funded plan. But typically what I see, and I've seen this with a number of employers, they'll see how that works and they're like, wait a minute, every year I do this, I win. Could I buy a bigger deductible? Well, the Affordable Care Act sets the maximum deductible that insurance companies can offer, but that's a partially self-funded plan. So let's move you into a plan that allows you to buy a much bigger deductible, lowers the insurance costs, and then we just pay for the claims as they come through. If a claim goes over the deductible, the insurance company pays for it.
Right.
So probably too complex of an explanation for this setting, but just to give you an idea, visually, when a CFO or a CEO sees it, the numbers oftentimes make sense.
Yeah. So, what's the risk? I guess, it's there's always risk to something, but real insurance is all about mitigating risk, right? So, what's the risk to not doing the traditional plan? This sounds like there's a lot of reward. How often does it not go as planned?
So the risk is you move into a partially self-funded plan and what seemed like pretty low risk population. I mean, here's the thing. I tell employers all the time, particularly when we went through COVID and there was a lot of turnover and companies are expanding and they're having to replace folks that are leaving. Their hiring volume has gone up. You're one hire away from your next large claimant. You hire somebody who's got a child that's very sick and needs medical care. It's expensive. So that is a risk. But going back to, when you're buying insurance at scale through a group health captive, I mentioned
Right.
it comes with contractual protections with it. So at the very start, what your worst case scenario is going to be cost wise. So
Okay.
they're going to set a maximum and you compare that maximum to what you're paying today on a fully insured basis. Maybe it's 10 points higher or 15 points higher than what you're paying today. But we can trend forward what your current utilization is and what these programs are going to deliver from a cost savings perspective. The average client is going to see about a 15 to 20% reduction in year one of their costs. But
Mm,
periodically, you'll have somebody that we've not had anybody hit the max, but it'll run higher than we initially projected because 3 people got diagnosed with cancer that year, right?
right.
But one thing to think about when you're talking about cost, there's cost savings and then there's cost avoidance.
Right.
2 very different things.
Absolutely.
So, it's important to benchmark just like you do your investments. So, if I came to you and said, Guess what? We did a really good job as your investment advisor. You got a 10% return this year. That is awesome, right?" Well, your question should be, "Well, what did the market do?" The market was up 50%. Did you get a good return? And
Yeah.
so it's the inverse math when you're talking about health insurance. Hey, the cost came in 10% higher than we projected. But if you were in a fully insured plan, your cost probably would have gone up about 30 or 40% because of this catastrophic utilization. So there's avoidance there. And the big dollars accrue over time. So when you look at the performance of the plans that I've described, the lines bifurcate much greater the further out you get from inception. And so that's why I always talk about having a long-term perspective, having a long-term strategy for managing this.
Right.
It can't be just year to year. We need to benchmark the performance of the plan to the market, and we need to benchmark it not just in a one-year vacuum. We need to look at how has this performed over. It's just the same reason when you buy when you buy a mutual fund, it's going to show you the 1, 3, 5, 10-year return.
Right.
We need to be looking at our health insurance plan the exact same way.
Mm. I was thinking that it's right. If you look at the daily volatility of your portfolio, right, your investment portfolio, it's dizzying
Mhm.
and all kinds of anxiety versus having a long-term strategy, a long-term investment strategy that makes sense. It's the beauty of editing. I can cut that out.
Yeah.
All right. Just make note of the time so I know where I'm cutting. Sorry.
Yeah, hold on, I got something coming up. I just refreshed my TV screen so that it didn't turn off.
Go for it. All right. I can cut that out. All right. I had one question. Um, I think you answered that. Um, I guess really the question, and maybe is that a good time to like, all right, hey, we've talked about the strategies, we've talked about the why. At this point, it's really a matter of an executive, a senior leader, probably asking questions, learning, trying to learn more.
Yeah,
Uh,
that's a really good point that you make. I actually got this piece of advice from a client recently, a new client, and they had been with the same advisor in the same company for over a decade. And I was introduced to them, and he took the meeting. The CEO took the meeting, and he said to me when we started the meeting, and I thought this was really relevant to this conversation. He said, "Look, I've got a really good relationship with my broker. We've got a good relationship with our carrier, but I really want to understand what I'm saying no to.
yeah,
I want to make sure that I'm making a prudent decision and I'm a good steward of my resources as my company's resources. And for me to know that I'm a good steward, I need to understand what I'm saying no to." And so that's why I always think it's important for as executives. Oftentimes we have our own preconceived notions.
to maybe dip a toe in this water. And it sounds like that is understand what it is that you're saying no to.
Yeah. So the number one thing I would say is you need to bring somebody in, find an advisor that has an expertise in doing the type of plans that I just described.
Mm.
Because just like I mentioned earlier, you don't want a primary care physician doing brain surgery. So you need to make sure you're talking to the right person that really has an expertise in this. Oftentimes, what I hear from clients when they become clients of mine is my broker kept telling me that this wasn't an option for me. We would ask about a captive or partially self-insuring or what other options are out there, and they constantly told us there's not really anything that you can do. We talked to another broker and they kind of told us the same thing, so we figured it wasn't really an option. But their CPA brings me in and I'm able to uncover going through that strategic review that we talked about. These are missed opportunities. This is what the vision and the strategy needs to be over the next 3 to 5 years. Here's the economic opportunity. Is the juice worth the squeeze? And a CEO and CFO looks at each other and says, yeah, we should definitely do that. Worst case scenario is we just go back to doing what we did before if it doesn't work. And I'll
Right.
go back. And so if you're not hearing somebody that's challenging that, you need to talk to an advisor, get a recommendation from your banker, your CPA, your business consultant, somebody that can connect you. I mean, I've got a network of advisors that I work with nationally. You may have somebody that's in New York or Oregon. I can connect you with folks that have the same mindset and philosophy, doing the same type of work that we're doing. You need an expert to solve the problem using the strategies that we're talking about.
Yeah, I think that makes right. So that's a good. Let's get practical. If you keep using the same tools, you're going to get the same outcomes, right? Keep doing the same things, you're going to get the same outcomes. So if you want to actually dip a toe in this, see what would it look like, you're going to have to find somebody. You're going to have to do it differently.
Yeah,
Or
isn't that Einstein's definition of insanity?
yeah, that's right.
Yep,
Doing the same thing over and over.
expecting a different result.
Different results. So try something different. So it sounds like somebody can reach out to you to, okay, so maybe I am in a different state. Who might you know locally that that you could refer to me if I wanted to learn a little bit more about my.
Yeah, and I know it's dependent upon the company and their goals and culturally. I mean, I have clients all over the country. I've got clients in California and New York and Florida and everywhere in between. A lot of the business that I do is in Texas.
Yep.
But I've had people reach out to me and say, I really want to work with somebody that's in my home state, preferably in my town. Can you help me out with that? I'd love to do that. I mean, it goes back to my million life goal of
Right.
affecting a million lives, and I can't do it by myself. And so, I'll just kind of throw this out there. I've got a checklist on my website. So if an executive wants to figure out, oftentimes we may not know the questions that we need to ask of a broker or an advisor to really get to the root of what is this person an expert at. And so in that checklist, I'll give it away. These are questions that you should be asking advisors based on the problem that you're trying to solve, along with answers and responses you should be looking for from an advisor. It'll help you separate the wheat from the chaff. Just like any industry, there are people that have expertise and subspecialties in a market. Health insurance is a big market. You've got Medicare, individual, small group, large group, corporate.
Right.
And then you have people that focus on fully insuring, and there's people that are experts in self-insurance. How do you separate what type of advisor am I talking to? Is this person really an expert at solving my particular problem? This checklist will walk you through how to ask those questions and what types of responses you should be looking for. So it's going to help you save you a ton of time when you're going through that interview process with a potential advisor.
Very valuable. All right, well, we'll give that website away when we wrap up. I've got a couple of let's get practicals to add, and then I'll circle back to you and say, what do we miss? Early on in the conversation, you said, don't wait so long that your decisions are tactical and not strategic, right? So it is getting involved early, but just the way you framed that is right. So in this whole process, don't wait so long that your decisions you have no choice, but you have to be tactical and not strategic in your thought process, because everywhere else in your business, you're trying to be strategic. So, and then I thought this was just a good awareness, a good tip for a listener that price does not always mean quality, and that there's data behind that. Because I do think that's a belief that a lot of people have, about about attorneys and about doctors and consumer goods, right? The higher price must mean higher quality. So I think that's good to challenge that. Um, Chris, what else would you add to Let's Get Practical, or have we covered everything?
I think yeah, what you mentioned, I think that summarizes it really well. Get involved early. I've mentioned it before, but challenge the assumptions, challenge
Yeah.
what your advisors have told you. We talked in the first episode about a lot of the misaligned incentives and conflicts of interest. They exist in every component of a health plan, including oftentimes with our brokers.
Right. Excellent. Okay, so now let's get back to the checklists. We gave this at the end of the first one, but let's give it here in case somebody hasn't checked you out in the last episode. What is the best way? Where do I find that checklist? And if I want to call you or if I want to contact you, is there an email address or a phone number that I should, or should I contact you through the website?
Yeah, so I've got a contact in the website. The website's fixedhealthinsurance.com. And I've got two pieces of information that I give away to employers. The first is going to be the Insider Playbook. So as an insider to the industry, I'm walking through the strategy and the thought process you should be using to design a high performance plan that helps your company and your employees. And that second piece is the checklist we discussed. It's a good handy resource if you're going through the process of trying to hire an advisor, how to compare and contrast, questions you should ask, and responses you should look for.
I think that's really valuable, is because you can give me the questions to ask, but I won't know what the answers are. I don't know if they're good answers or not. So that's really valuable. Listener, I would encourage you to go check that out. Make sure that you are, again, if you haven't listened to episode 1 for the greater context of how we got here, there was a lot of great meat, a lot of great value in that episode as well. Chris Hamilton, thank you for joining us, not for 1, but for 2 episodes of this podcast. It's been, I've learned a lot, and I know that our listeners will as well. Thank you.
Well, thanks for having me. The pleasure is mine.
Of course. And listener, you can make sure that you are, if you're listening to us in the podcast libraries, did you know that we have a YouTube channel? So if you go out to YouTube and do a search for the Frustrated CEO podcast, you can find us there. And if you're watching us, then make sure when you're driving that you're listening and not necessarily watching on YouTube. We don't want you needing to use your insurance. So thank you, Chris, for joining us. Big shout out to my colleagues who are not here today, but who I know will be back for future episodes. Listener, thank you for sticking with us to the end of another episode of the Frustrated CEO podcast. We'll see you next time.